How many can you actually get on the screen?
9.
Okay.
Okay, welcome everyone to the first meeting of the local pension committee since the annual meeting of the county council. Just to let you know first, we've had a few apologies from Mr. Hunt and Councillor Frost and Councillor Graham. I also understand that Councillor Adam Clark is going to join us slightly late. On to the first item of business, appointment of chairman. Mr. Osborne was nominated as chairman-elect at the council meeting held on the 8th of July. Can I ask the committee to formally nominate this and second it?
I would nominate Mr. Osborne as chair.
And can I second it?
I'll second that.
Thank you. Mr. Osborne.
Thank you very much indeed. As you're probably aware, this meeting is being broadcast live via YouTube and it's available for viewing after the meeting. Due to the current situation, the meeting is taking place virtually with members of the committee along with officers presenting reports joining online. Can I please ask that all members and officers have their microphones on mute until they wish or are invited to speak. And when you're speaking, please make sure your video is turned on. We like to make sure that you are actually here and you haven't switched just to the picture and gone off and gone gardening or something. Right, the election of vice chairman. Could I formally nominate Tom Barclay as vice chairman?
Mr. Chairman, I second that proposal, Mr. Chairman.
Okay. Is that all right with the other guys?
Yes, Chair.
Okay. Thank you very much. Minutes of the meeting held on the 19th of June. I propose that the minutes of the meeting are taken as read, confirmed and signed. Is everyone in agreement?
Yes, Chair.
Yeah.
Thank you. I've received no questions under question time, and I've received no questions from members under agenda item 5. I've not been notified of any urgent items under agenda item 6. So the next is to ask you, ladies and gentlemen, if any members have any interest that they wish to declare. Okay. Then we'll go on to start on the substance of the meeting, which is the risk management internal controls budget update, and Declan is going to join us for that.
Thank you, Chair. Thank you, Chair. Sorry, I had the microphone in the wrong place. So it's the risk management report has been slightly expanded compared to what we normally sort of show. So there's 3 sections this time. There's the usual risk management update, a brief summary of the internal audit actions for Lgps Central as opposed to the directly fund itself, and finally a budget monitoring update, which we haven't done before, which is obviously kind of good practice that we do want to get into the habit of doing. So in terms of the risk management update, there's just three points there. None of them are particularly major. The first one about the guaranteed minimum pension data isn't a new risk as such, it's just clarifying, it's just bringing clarity to the register, so it's not a new issue that we're facing. It's always been there in truth. In terms of the contributions banding, is a slightly odd one in that it's kind of if the risk arises, it does impact the employer themselves directly, and it's only that employer that's impacted. It's not one that sort of spreads across to the fund. You know, so if the county council got it wrong, it doesn't mean that the university suffer, etc. But what it does mean from a fund's perspective is that the employer could be further behind, have a greater fund deficit than otherwise be the case, and put them under increased pressure as an employer, where that load should have been spread with the employees to make that contribution. So that's just it's a slightly odd one there. That's kind of a bit of an indirect impact on the fund. And the final one, risk 8, the immediate payments members of the committee, or if the ones that are on it anyway, will remember probably a couple of years ago we started sort of a series of system upgrades on the pension administration system. And this is the final kind of the final module to kind of get resolved. And one of the reasons it got put to the back was it is a bit clunky, and it's, although the sort of the working with the sort of the vendor to sort of improve it, still is a bit clunky. So there's a bunch of sort of manual workarounds that have gone in place, primarily around additional checking to make sure that we sort of don't make any mistakes. But obviously that kind of it's not an ideal sort of scenario from a sort of a resource utilization perspective, and even the risk of error. So that risk has got being added there, but they are pretty hopeful that's kind of going to subside quite quickly over time. The next section of the report, the internal audit activities, obviously not a big section. For LGPS Central, Staffordshire County Council do lead the internal audit work, and then the different partner funds do pick up different audits on a kind of a rotating basis. The main event to sort of highlight to you there is this AAF report, the Audit and Assurance Faculty Report, which is done around internal controls in the company, which is obviously, LGPS Central is still quite a new company. It's only sort of a couple of years old. So it was a key report to just make sure things are operating kind of under the hood as they should be. And although there was a handful of recommendations raised, overall it was a good report. So there was sort of good assurance raised there, and it's an exercise they're going to repeat again, which should give some sort of some reassurance to the committee of how things are being run. The final section of the report, the budget update, I'll just pull out the key sort of points of interest really. The staffing's in line, but McLeod is mentioned there in the report, and Ian's coming along later to talk about sort of the McLeod issue itself, and that has quite a big impact on the administration section, because they're the ones who have to, as part of the remedy, basically calculate sort of pensions multiple times under multiple scenarios. So a temporary team is being set up to deal with this, and although it's kind of kept within budget this year, because the team's getting set up later in the year, it is undoubtedly going to cause sort of budget pressure next year. Just on staffing, it's probably a good time to mention as well the county council, due to the sort of the financial sort of financial issues brought around by the COVID crisis, is introducing expenditure controls. But these won't, even though the pension sections are employees of the county council, it's not going to apply to the pension section. That is, its funding situation is very different from the county council, so there isn't going to be any knock-on impact into there, just in case that was causing any concerns. The next section, just pick up the actuarial costs. There's a comment in there. It sort of sounds slightly odd about recharging costs to employers, and this is it is quite difficult sometimes to work out, looking the year ahead, where the work's going to fall in such a heavily regulated environment, between sort of items that affect the whole fund versus items that affect individual employers. And it's kind of the work that is recharged to employers tends to be sort of work that they've instigated themselves anyway. So it's not that they've been costs being shoved onto them that they're not expecting. It's just the way that the work has fallen. Next one I was going to pick up was the LGPS central cost. Members all remember when we brought the budget back in February that there was a comment that the budget hadn't been agreed at that sort of stage for one reason or another with central. That has been agreed with partner funds now, and it was in line with what we were expecting. They're underspending a little bit. It is a bit of I suppose a mixed message when they do underspend, because the underspends tend to be driven by them being late with sort of launching products, which isn't really what we want, but it is what it is. And the final one, again, won't be a big surprise. Management fees are significantly sort of down. We obviously kind of, with the stock market crash brought about by sort of the COVID crisis was in March. So our starting point for the year with assets was materially below where we were expecting to start out. That position may change, depending on the strength of the stock market recovery. But with a UK biased fund that we do have, and members will have seen where the FTSE is sitting at the moment, it's unlikely that we'll sort of catch all the way back. In truth, it's extremely unlikely. That was just a summary overview of the report. Happy to take any questions that members have.
Could you indicate with your hands up, or physically just put your hand up, if you want to ask Declan a question?
Zubair wants to ask a question.
Zubair.
Hi, thank you, Chair. Hi, Declan. Thank you for that quick summary. Appreciate the clarification on the actuarial cost recharge to employers. Just one particular question, but before that, I apologize if you can hear any background noise. I just by chance happen to have some roadworks happening outside my house, so hopefully it's not causing too much distraction. Just a quick point, Declan. You know, on the risk register, you mentioned the new risk added, risk number 7.
Yeah.
Regarding contribution banding, which has an impact both on the fund in terms of incorrect income being received, but also from the employer's side, not actually paying over what they should do. And just wanted to find out, is that something that's just been how did that risk arise in terms of the new risk and in terms of mitigations to make sure it doesn't happen, or it's being monitored to ensure it doesn't sort of play out as the risk sort of sets out?
So it's probably one of those. It's always been there. There was a obviously for as long as sort of employees have had to make sort of contributions. It's the reason we've added it on the risk register because an internal audit report was looking in that area and the checks and controls that were done in there. So it's kind of sorry, phone going in the background. So it was added more for completeness as opposed to sort of something sort of fundamentally is changed. And I think we've done quite a bit of work obviously on the back of the triennial valuation, which is a slightly different issue but it did sort of bring into the spotlight that we need to make sure that the money's coming across. So the way it tends to work at the moment is for all the 200 employers on the fund, there's some poor blighter in the finance department has the joyous task of actually going through and checking those and that they are in line with what they expect. Now, obviously, it's kind of the payroll does vary each month. It's not an exact check, so you can't do it sort of. You can't do it perfectly, but we do those sort of sanity checks as they're coming. And as you can see there, I think the back of the internal audit report, they recommend doing a bit more kind of sample checking and things like that. But I suppose the assurance is that it is, if there is a problem, it does stick with that employer. You as a university won't suffer because the city council got it wrong or anything like that. But it is just more about that, making sure that the employers aren't overburdened with a contribution that the employees should have made.
Okay. All right. No problem. Thank you for the clarification.
Okay.
Okay, if there are no other questions then, thank you very much, Declan, for that. We'll move on to the governance update report, which is, I think, Bullish, you're doing that one.
Okay, thank you, Chair. So this is a standard report really now. We've got a governance update, some external developments and a section on responsible investing and the Corkly stewardship report, which we've been having for the last 2 quarters. For the additional topics, we've got a section on Lgps funding flexibility, a section on Supreme Court judgment regarding the Palestine issue, and we've got a small section on good governance phase 2. So if I just move forward to point 9 on the paper, Lgps employer funding flexibility. These are new regulations which will be coming through in the next month. There's been a long consultation and it was largely supported, so we had 97 supports and only 4 opposing, I believe, in point 9. And it allows funds to review contribution rates between formal valuations, so between the three years. If there are significant changes to liabilities, if there are significant changes to employer governance, or if an employer requests it. It also gives funds the power to agree payment plans when employers have a debt or when the last employer leaves the fund. I understand our fund already does this, so we're ahead of the game there. The last section on there is allowing deferred employer status to be introduced. An employer can stay in their respective fund even if their last active member leaves, rather than making payment of the cessation termination value. As of the 1st of September, the fund has not had any request to consider review of employer funding rates. We are keeping in contact with some of our larger employers just to make sure that the current crisis hasn't presented any particular problems. Ian and myself have been speaking to a couple of employers in particular, but as of the current date, we have no particular issues to report. The next section here is point 13, which is the Supreme Court judgment on LGPS statutory guidance and the Palestine Solidarity Campaign case. If we just forward to point 16 and 17, the court's judgment provides clarity and further reassurance around the extent to which non-financial factors may influence investment decisions within the LGPS. The guidance will not change for us. The relevant paragraphs were removed in 2017. Our fund would adhere to its current policy, which expresses a preference for engagement rather than divestment. And we do that with engagement with LGPS Central and their RI teams, and we also have membership to the Local Authority Pension Fund for LAF. The next section here, as an update, is the Good Governance Phase 2. We are implementing changes. Some of the areas are awaiting further guidance, but whilst we're doing that, we've instigated a review of the terms of reference, and we've also asked for an independent advisor to form a high-level governance review, which we hope to bring to the November committee. Moving on to 19, we've got a quarterly voting report, which is an appendix to this report. This quarter presents the highest number of meetings that we can, or LGPS Central on our behalf, can vote at. Point 21 points out that there were over 3,000 separate company meetings, over 44,000 resolutions in the quarter. And point 22 also points out that management voted against or abstained on over 33,000 resolutions. Similar to last quarter, the majority of these votes against were for board structure related resolutions, followed by remuneration at 12%. So we had 53 board structure, 12% remuneration, similar to previous quarters. Point 25, moving on to, just before we do so, they cover off most of our equity funds. So I'll just get back to point 20. Yeah, so the number of shares that we're covering off here include the two active equity funds that we have at Central, plus our LGM assets. They're at 44% of our total holdings. We've also got some assets with Adam Street Partners, Pictet Own Equity and Ruffer, between them and another 13%, which we're hoping to pick up for the next quarter. So we'll have a greater number to report, and therefore most of our equity will be represented within this report. Next section is the Corkly Stakeholder Report. Just like previous quarters, there is a appendix for this, which details the kind of engagement that has occurred in the past quarter. I'll just forward on to point 26. Central cover off 4 engagement themes. So they have for this year climate change, single-use plastics, fair tax and tax transparency, and technology and disruptive industries. It's similar to last year, and I'd like to give a short update within this report, which means you don't need to, or you can read through the whole appendix if you want, but point 28 points out that this quarter they've taken on plastic pellet pollution and collaborated with a number of firms, the British Plastics Federation and British Standards Institute, to create something that doesn't leak plastic into the seas. The responsible investment plan is point 29 onwards. We are receiving some training today. The plan, as you can see on the table, we are on schedule for all of those. We're currently halfway down that table, and we've got some training today at the end of this committee from Michael Marshall regarding how ESG and RI is incorporated into manager selection. Given that we're moving towards products delivered by Central, it's important to understand how those managers are selected and what RI policies they have. Another point to note, and we have the climate risk report, which has started to be developed by Central, and we hope to get that in for the November 2020 pension committee. That's all I have, Chair.
Okay. Are there any questions to Bulesh on that report? If not, I mean, I've got just one slight observation, and it's I find the paper on the engagement and stewardship themes Really a very good read. However, it seems to me that at times there is a struggle with some of the larger and emerging technology companies who don't always listen to what the shareholders are saying. And I'm just thinking of on page 47 of Alphabet. But it's in slight contrast, and I hope I'm not thought of being too reactionary in this era of being woke, whatever that means, is that on the next page, on 49, I see on the examples of voting decisions that there's a concern over the chair of nominations committee, Charles Searle, being reappointed. Now, he represents NASPA's interests. NASPA's a South African company that was the largest investor when Tencent was a tiddly push-nothing company. And I don't think it's unreasonable for the company who's the largest investor in Tencent and the longest serving investor in Tencent actually to be chairing the nominations. And I haven't seen anything that they have, as it were, done wrong or is ill-advised, whereas I do find it objectionable that Alphabet company doesn't take any notice of 45% of the independent votes cast on the Human Rights Oversight Committee. It just seems a difficulty that we're having with the technology companies over which they just seem to go their own way, whatever happens.
It's definitely one we can bring up with Lgps Central's RI team, and we can certainly bring Val and the team back to understand how we're going with these things. I can imagine there'll be votes cast and there'll be special shares held that allow boards to get away with what they want, but I think it's probably worth bringing Val back for things like that.
Okay. Right, are there any questions to Bush on that?
Oh, I think Mr. Clark.
Tom?
Yeah, thank you, Chair. I appreciate that there's no pension deficit at the moment. It's really quite difficult, given the wide fluctuation in valuations, to address that problem. I just wonder what policy we have, at what stage or how do we manage when we're asking employers and employees to make further contributions because of deficits, if they arise.
Yeah, it's true. I think we need to build a policy on this. Ian is on the call, and between us, we need to come up with a plan on how we can engage with employers who may be facing difficulties. There might be a number of options we can go down. Financially, we just need to assure ourselves and the fund that we're making the right decisions. Ian, I think Declan's about to come on.
Yeah, I was just going to say it's one of those considerations, but we are in the fortunate position of no employers yet have come to us sort of saying they're struggling with their contributions, and maybe that reflects the sort of the heavy sort of public sector dominance of the fund. But no, you are right. It's something we do need to be alert to, because there's no point kind of tipping somebody over the edge for sort of a short-term gain when you could maybe help them to see it through. But yeah, we are minded of that.
Okay. All right, Tom.
Thank you. Yes, that's fine. Thank you.
Okay. Right. Thank you very much. You're asked to note the report. Moving on to agenda item 10, which is looking for approval for the new exit credit policy. That's set out on pages 57 to 106. So welcome to Ian Howe, our pensions manager, who's presenting this item.
Good morning, everybody. I hope you can all hear me correctly. Thank you, Chair. This is a policy that we do seek approval for committee for the proposed changes to the fund's funding strategy statement on exit credits. I think if I could just briefly give you a little bit of the history to explain why this is here. Prior to May 2018, if an employer left the pension scheme in surplus, the surplus remained in the fund, and that was used to pay future liabilities for future spouses' pensions, members' pensions. The regulations changed in May 2018 to effectively allow the fund to refund any surplus back to the exiting employer, which created concern nationally. We weren't the only fund to be concerned about this. And I liaised with colleagues, legal colleagues, and also colleagues at MHCLG about this, and I wasn't alone in doing so. And off the back of that, we were given strong assurance, really, that we were in a position whereby we were to retain them. So whilst the regulations were saying we should effectively refund them, we felt confident enough not to, because we had understanding that the regulations were actually going to be amended back to the position prior to May 2018. So we chose not to pay large surpluses back. Following this, there was a consultation that then took place, and there was strong support nationally to effectively reverse the position. In March 2020, the regulations were then changed again to basically broadly reverse the situation back to the position in May 2018. But what it required a policy that each fund needed to have within its funding strategy statement to allow this to happen. And this is what the purpose of this report is for. So I proposed a policy change, and that was drawn up in conjunction with our legal colleagues at the council. And I took that to the pensions board, who supported the proposed change to the funding strategy statement. I then took this to consultation with the fund's employers, which I have to do as part of a change to the funding strategy statement. And rather surprisingly, I didn't get any replies at all from any of the employers within the fund, which I was a little surprised about. But we did do that thoroughly, and we sent that out. We provided all the information to the employers about this and the reasons for the need for the consultation. The key points really are in points 10 and 11 within the report. So I'm just going to read those out. The policy makes it clear that no exit credit will be payable to employees who join the fund prior to the 14th of May 2018, unless they are subject to a risk sharing arrangement, as exit credits were not permitted under the regulations at that time. And number 11, the policy also makes it clear that no exit credit will be payable to employees who participate in the fund through pass-through arrangements, as the majority of the pension risk is borne by the letting employer, and the exiting employer would not be required to pay any of the deficit or receive any surplus at the end of the contract. And this is the arrangement that the parties will have entered into in the admission agreement from the fund. So the actual changes to the policy are detailed on pages 16 and 42 and 44 of the actual appendix within the funding strategy statement. So I would really just seek any questions and hopefully your approval to support the policy change. Any questions at all from any of the colleagues?
Any questions to Ian?
Yeah. Can I just come in, Chair?
Please.
Yeah, just thinking, why aren't they, when we send the information to the employer, why aren't they responding to the request that we asked for? Do they not want to be participate or what?
I don't know. I was a little surprised that I didn't get any replies from any of the fund employers. Hopefully they were supportive of it, and they appreciated the need for the money to stay in the fund. So maybe they didn't reply because they were happy with the view, but I couldn't honestly say why they didn't reply. I was a little surprised.
Okay, thank you, Chair.
Simple, tell us.
Yeah, sorry. Hi, Ian.
Hello, Zuba.
As an employer, I feel a bit in the spotlight on this particular question.
No, it wasn't. It
but,
wasn't aimed at you.
No,
Please don't think it was.
No, I'm just no. I take the point, and thank you for presenting the paper in quite clear and concise points. I think from my perspective, the only thing I can think of really was, and I'm sure it wasn't deliberate. It was probably just by design in terms of how things have worked out. It's just the timing in terms of when that consultation went out from the end of July into the end of August, and that's the time when a lot of the most of the especially the education employers would be sort of working in through the summer time. And I'm sure it works for most employers as well in terms of the overlap with the summer period. Now, whether people have had a chance to pick it up but just didn't get a chance to look at it in more detail is just probably one consideration I just wanted to put forward, because certainly if I wanted to take it any further, I would probably need to have further discussions internally and availability of the relevant colleagues within the business to be able to discuss what that could mean for us. And speaking very plainly, these are sometimes complex arrangements that are not as they seem on the face of it. There's a lot of history behind it, as you've clearly indicated. So I'm not taking away from the fact that you reached out to employers. Absolutely. It's just I think maybe the timing of it over July into August possibly might have been a factor potentially. But on the face of it, I mean, in terms of, I think some of the points made out regarding historically, I suppose one of the fundamental points that stands out for me is where there was an employer leaving with a deficit, there was no requirement to make good that deficit. Is that correct of me to say that?
No. If an employer was leaving with a deficit, what happens in those cases, Zubair, is we work with the fund actuary, and the actuary will work out what the cessation debt value is. And then the employer would make payment of that, and then they would walk away. This is only for those in surplus. So any in deficit would actually make payment before they walk away, and then once that payment's been reached by the fund, effectively they've met their requirements within the scheme rules. These are actually only those employees that leave in surplus, Zubair. Okay.
I think the only final point I wanted to just make was, I'm not sure whether there's any time pressure to get this particular policy approved, is whether on the back of the context of the timing of when the consultation went out, whether there is any merit to possibly have second opportunity to possibly look at that again for employers, potentially a couple of weeks or so, maybe. I don't know. I'm just throwing it out there just as a chance to say, if you've had absolutely no response at all, that is, obviously a good point that Councillor Govind has made as well, and yourself as well. So I just wanted to just put that out there to see what any thoughts are really.
My thoughts in terms of a reply, I would personally prefer not to, because I have a number of cases that are leaving very, very shortly, actually not very long after this meeting, in surplus, and I would really like this policy in place to protect the outsourcing employers for those contractors who are leaving in surplus after this meeting. But I do take on board your point about the timing. The timing is unfortunate, I guess, in terms of it being over the summer period, but I'm afraid that was just the reality of the consultation period, I guess. But I would probably I will take that into account for future, but I would personally prefer not to delay this, in truth.
Can I just add to what Ian's saying there on the sort of the employers in surplus, is that these are often kind of employees who've just sort of taken on sort of shorter term contracts from kind of, I don't know whether it's universities, academies, things like that. And when they tend to enter into these contracts, they're not expecting to earn a surplus from the pension fund. They've just got lucky with the timing of kind of stock market sort of improvements and things. So this is why it bites us quite hard, that you kind of resent it, because if they're leaving a deficit, they argue like crazy about it's not theirs to pay. Why should they pick it up? But if they get it's sort of manna from heaven almost, that they want to keep hold of the money. So that's why Ian's really keen to kind of shut the door on this, and why as an administering authority we are really keen to do it.
Okay, no, thanks. I appreciate the clarity.
Thank you.
Okay, if there are no other questions on that to Ian, you're asked to approve the proposed changes to the funding strategy statement in relation to the exit credit policy. Can I ask you, is that agreed?
Agreed, Chair.
Okay, thank you very much. Agenda item 11 is the MacLeod Sargent. The amendments to the statutory underpin is set out on pages 107 to 128. Ian, I think you're presenting that one again.
Yes, thank you, Chair. Thank you. I'll give a little bit of history on this one as well, if I may. The report is to seek approval from the Committee for the Funds reply to the consultation on the statutory underpin. I think it's worth just explaining a little bit what this is around, because again, there's a lot of, well, there's a bit of history to this, similar to the last report, actually. In April 2014, the local government pension scheme regulations moved to a career average calculation. Prior to that, there were final salary benefits, but members who were within 10 years of retirement had additional protection inbuilt. So effectively, if their final salary benefits were higher than the career average, then they received the higher benefit. So they had that additional protection. Now, what happened was this was then challenged on age discrimination grounds by a couple of individuals who are known as Mr. I think it was Mr. Actually, it was a MacLeod and a Sargent. I don't know if it was a Mr. or a Mrs. Actually. MacLeod and Sargent appealed. One was a judge and one was a firefighter. And to cut a long sort of legal story short, they ultimately won their appeal. And what is now happening is government are seeking remedies, solutions to how this is going to take place across public sector pensions. And there are various consultations taking place. There's one that's broadly covering all public service arrangements, but there's one that's specifically dealing with the local government scheme, and this is the one that I'm replying to. So the remedy that's been proposed, there's a consultation out and there's 29 questions asked of people who wish to reply. And I've proposed our reply, which is within your pack, and that's pages 111 to 121. It's the 29 questions are in there. The key in terms of how this is going to work, though, we do know whatever the decision on remedy is, what we ultimately will need to do is we'll write to all of the fund employers, all the 200 employers in the fund, and we basically need to get people's hours between 2014 and 2022 and service breaks, and then load them onto the pension system and then rerun the pension benefits and compare the benefits based on the care to the final salary with protection. And if the revised benefit is higher, then we will put that into payment. It is a little bit more complicated than that in terms of a further check then takes place when the member then leaves, and actuarial reduction factors or increase factors are applied. So it's not always as simple as identifying straight away whether the revised benefit is higher. It could be that it becomes higher later in the member's period of employment towards their retirement age. But that's principally what it is. Declan mentioned MacLeod earlier when we were talking in the first report about the staffing budget, because this does have implications administratively. Looking at revising somewhere in the region of 7, maybe 8,000 calculations of members' benefits, and that includes people who've left, pensioners, preserved members, and obviously active members whose benefits aren't yet in payment. So there's a significant amount of work to do, but how many members will actually receive an increase is hard to say. It might well be that we do all those recalculations and not many actual cases actually receive an increase. So it's really quite hard to judge until we get further into this. But that's really what MacLeod Sargent is about. It's to resolve the remedy that's been brought about by the age discrimination, and your support to my consultation reply is what I'm requesting today. So any questions at all? Thank you.
I take it then that nobody's indicated I've got a question for Ian. Thank you very much, Ian, for the work that you've done on it. Pardon me. The committee is asked to approve the fund's reply, which is provided in Appendix A of the pack.
So I've just had Jackie Deans raise their hand.
Who?
Jackie.
Jackie.
Hello. Can I ask Ian whether he thinks he's got the resources to do what seems to be a large piece of work?
Thank you, Jackie. Yeah, we're doing a reorganisation of the pension section, and that actually comes into force, Jackie, on the 1st of January. And as part of that, I'm going to have a team that's temporary to deal with McLeod. It's going to have one team manager and 2 senior pension officers. That's my starter, and I'm going to see how it works, Jackie. It really depends on on 2 things actually. How many cases are actually impacted that will need revision, and also if the remedy sets a deadline in terms of having this work completed, I will probably have to move more resource into it. Currently, the remedy doesn't mention any deadline at all, Jackie, which is really helpful. So I feel we're comfortable enough for now, but I think we need to wait for the end of the remedy before I'm absolutely clear. I do also have a little bit of support from the systems team who are going to help with some of the loading of the information and the hours back into the systems as well, Jackie. So there's a number of areas I'm working on, but I think it's one that's going to be hard to judge until we're much further into it, Jackie, in absolute truth. But I do feel confident enough where I am at the moment.
Okay, thank you, Ian.
Thank you, Jackie.
Any other questions to Ian? If not, could I ask members to approve the fund's reply to the consultation, which is in Appendix A of the pack? So is that agreed?
Sorry, Chair, could I just ask one quick question of Ian, please?
Yes, please do.
Yeah, sorry, Ian, just a quick one. Ian, just remind me, if I'm not mistaken, during the last full valuation, I can't recall exactly, was there a provision made for including the impact of McLeod on employers' contributions? But I understand that there was a caveat to say this is obviously still in motion, and once it's probably more settled and finalized, which, looking at the response you've given to Jackie, probably assumes it's not there yet. But I suppose my question more directly is, there's an expectation that there'll be a ripple through onto effectively employer contributions at some stage.
Yeah, thank you, Zuba. I should have probably mentioned that. I do apologise. I was coming at it from the administrative angle, but you are absolutely right. When we had the valuation, we took account of McLeod, but it was really hard to judge at that time, and it remains so, Zuba, to be honest. But we took account of that with a 1% rate within the valuation. So it's been scoped in. Whether the ultimate outcome is more or less than 1%, Zuba, in truth, I don't yet know. But yes, you're right. It was taken account of within the valuation.
Okay, thank you, Ian. Thank you.
Thank you.
Okay. Can I ask then that you agree the reply to the consultation, please?
Agreed, Chair.
Agreed, Chair. Agreed.
Okay. Thank you very much. We're moving on then to the investment subcommittee membership. And that's you, Kat.
Yeah, this is just our standard report we bring yearly on the membership of the ISC, and it also sets out the dates of the investment subcommittee for the remainder of the year and next year. While we don't, while the ISC doesn't need to select and interview managers in the same way previously had done because of pooling, we still feel the importance of the committee to be able to make decisions in line with the strategy agreed by the local pension committee. But I don't really have anything else to say. Any questions?
Any questions? Kat, is fairly straightforward.
Yeah, can I just come in?
Please.
So thank you, Chair. Kat, just on the subcommittee, are they all based county council representative? Are there any from city on that subcommittees?
Yeah, so it's set out in the report. We've got 3 county councillors, and then we've got 1 city councillor, which I think has been nominated as Councillor Clark from the city. And then we also have 1 member representing the district council, and then the member representing the universities, as well as 1 non-voting staff representative on a rotating basis.
Okay, Chair. Thank you. Thank you, Kat, for that.
Okay. Okay, could you please, ladies and gentlemen, note the report? Okay.
Noted.
Noted.
Agreed. Yeah.
Right. Moving on to the agenda item 13, which is the summary valuation of pension fund investments, and that comes back to you, Declan.
Thank you, Chair. So the report's the fairly standard report that you normally get. So I'll just sort of pick up the highlights in it really. The first thing I was just going to draw members' attention to was just the table in paragraph 4, which just kind of it sets out quite nicely kind of the I suppose the volatile and kind of unusual times in some ways from an investment perspective. And you can see, if you were to just purely look at the 3 months, you'd think kind of investing was kind of an easy job. No matter where you put your money, it was kind of going to come sort of good for you. But then as soon as you sort of open your eyes a little bit to the 1 year, you realise what sort of what a tough time sort of certain asset classes are having, and as well, in some ways bizarrely, the kind of equities are kind of up over the course of the year. Although it should be stressed, if you follow the financial sort of press, as it were, that's really driven by sort of a small number of companies. If you take the S&P 500 in the US, it's kind of, I think it's something like 5 companies are driving their kind of historic highs, and the other 495 on average are still behind where they should be. So it's really kind of a strange time with sort of a lot of divergence between kind of between elements of the economy, really. And if you look down there, gold at 30% over a 1 year period, and it's not as if gold was cheap coming into that year as well. So it's only really when you get into the 3 years things start to settle down. But you can see gold's a good indicator of kind of sort of people's view of fear and stuff, still at 15% over 3 years for something that's kind of we don't tend to consume it. So it's not as if it's running out. So it's truly have a sort of very very sort of strange times. And that is mirrored to some extent, although not as extreme in terms of the fund's performance. And there's a quick summary early in the report there on sort of paragraph 7, where kind of 8% over the quarter is kind of twice what we'd normally look for in a year. So it's kind of, on the face of it looks good, but when you get to the sort of the 3 year picture at 4% is a little bit disappointing, which is kind of then exemplified in paragraph 8 in terms of where that leaves us with our investment returns compared to the sort of triennial valuation. Although there is always that big caveat on that we're only kind of if this is the worst event in our 20-year period, we're going to be absolutely laughing. It's probably there's probably going to be something else like this happen again in that 20-year period. But it is that just kind of keep your eyes on we're a long-term investor. It's not as if we kind of we've bet the house on everything and lost it. We've got a good diversified portfolio. So the expectation still is this hit isn't big enough to knock us off our plans. Another one could come along, but as we sit here now, it's not too bad in the scheme of things. The report then goes on just to sort of talk about how we vary on the sort of strategic asset allocation, so paragraphs sort of 9 to 15, and just where we've got our money compared to where we said it was going to be when we did the strategic asset allocation review back in January. And the volatility we just talked about does knock that asset allocation out of shape. A good example is the cash there at sort of 2%. which is far more than we'd normally hold. We'd normally even try and get it, below benchmark if we could, and that's really driven by the currency hedge. And if you go back a few months, the pound was sort of sinking against the dollar, and the dollar is the primary kind of currency or foreign currency that the fund does invest in. So it does influence a lot. But over the last month or so, kind of the dollar's been sort of tanking and allowing the pound to go up. So hence we've had a lot more sort of cash coming in. So that volatility really does knock you out of shape. I mean, true, some of the big differences as well though are because there was changes in the strategic asset allocation that haven't been sort of actioned yet. The big one in the alternatives that's down by sort of 2.6% is because we wanted to invest in the multi-asset credit fund that Central are developing, and Bhulesh will come onto this later. Until that product's ready, we can't move the money around. The other thing that's happening as well is just opportunities. We asked Colliers a few months ago to start looking at property, and obviously the COVID crisis doesn't help with things like this, and particularly with sort of illiquids, it can take a while to get into them. We know we're below on benchmark over that. The money's still pretty much sitting in equities, so it can take a while to unwind those things. But overall the benchmark's not too bad, but as the volatility settles down, we may need to start looking at some of the areas, particularly those illiquids, about where we sort of put the money in. The report does touch on as well. Now, this doesn't affect the allocation between classes. It's all within equities. The climate funds that we were going to move some of our passives from the sort of the general passives into the climate fund, which is another sort of form of passive. It's just got a different tilt to it. This is this is working through sort of transitions arrangements at the moment. Obviously, when you're moving hundreds of millions of pounds, it's worth getting the advice. And the cost of moving funds at the moment is higher than it normally is with all the volatility. It costs a lot more to sort of buy and sell in and out of positions. And the report then moves back into as you get down to paragraph 16, the performance of the fund itself. And you can see it is a bit disappointing over the even over the 3-year period where we're behind benchmark. And that's driven by the a mixture of the equities and the alternatives. In terms of the equities, obviously the passives just do what passives do and just track. So it's really down to the active products that we've got. And the one I'd pull out there to draw your attention to is the global equities. And since we've been with Central, and in truth before that as well, where we did the two other the two other managers, we have been behind the global benchmarks, and that's because our tilt has been to what's been called value, whereas it's been kind of growth type stocks that have really driven the market. And the example I touched on it before, it's your Teslas, it's your Apples, it's it's companies like that just seem to have a never-ending ability to attract money into them, hence driving the valuation up. And both our old global equity product and our current one with Central are underweight in that area, so they are suffering at the moment. It has been a gradual move away from value. The previous two managers were both kind of value tilted. With Central, it's a much more balanced fund, but there is a value manager in there who kind of dilutes the benefits a bit from a maybe a pure stock picker. In terms of the alternatives section, this is dominated by targeted return, and it's one of those areas we've talked about quite a bit about the value or otherwise of that bit of the portfolio, and it's a real mixed bag, as it always is. Ruffer's prophecies of doom kind of came to pass back in March, with huge volatility coming back in. So they've done really well over the last year. The issue is always with Ruffer is that they are very stuck in their opinions. So they're just assuming that the world's going to get kind of worse again. So which is okay, but the problem is you could be waiting a year for this to happen. You could be waiting 10 years for this to happen. So it may be that we end up another period of underperformance with Ruffer. You'll see as well, we've kind of got obviously Aspect and Pictet. Aspect are as volatile as anything, as they always are. They had a good 6 months, then not such a good last quarter, but they are more spiky than the other ones. So it is a useful area to have, in that it doesn't correlate particularly well with equities, so you are getting that good diversification. As equities have come up, Aspect tend to have suffered a bit, and Pictet can get caught in the middle a little bit. They're a bit more of an equity manager than maybe the freedom that Ruffer do employ. So they have been behind in the recovery as well. So that's why we're behind a bit. We'll get a better view over the next next quarter, 6 months, when things do start to hopefully stabilise. You can get a bit more kind of clarity. Have we got any any areas that are a genuine long-term concern versus ones that are just sort of suffering at a phase of the market. That's all I was going to go through. Happy to take any questions on the report.
Okay, any questions to Declan? Okay, nobody's indicating Declan. I just would say as a comment, yeah, I'm glad to see Rupper coming good after a long while of patience.
No, there's nothing worse than sort of almost making a bet and it never happening. But yeah, I think it's one of those that the strategic asset allocation has got us divesting from Ruffer at some point, and when we get close to that time, I suppose that there probably is a conversation about, is it the right time to come from someone who is a bit of an insurance product in the fund, or do we actually say we've done okay, now is the time to get out of them?
Yeah, I mean, I'm personally not sure that it's correct to say it'll result in higher inflation, but however, if it comes good, that's fine. Okay, could I then ask you on that report just to note the report? Okay, we'll move to the. Sorry, Mr. Gervin.
No, I said agreed.
Okay, thank you. Could we move on to item 14, the strategic asset allocation update, and that's yours, Bullish.
Okay, thank you, Chair. This report's a bit of a prelude to the report that we'd normally have in January, which is the main event where Hymans would normally come in and talk to us about the changes that they expect the fund to make in the following year. So this is just to let you know, we've commenced engagement with Hymans again. We expect them to have a new strategic asset allocation paper ready for us, and a strategy, if you like, by the end of 2020, so we can come back to committee in 2021 January. A bit of background on here. We look at points 5 really, just to reiterate that our fund currently targets an investment return of 5.9%. We have a 50% chance, we believe, of beating that over the next 20 years on average. The actuarial valuation assumes a far lower number, 3.8%, and we expect an 80% likelihood of meeting that. And that kind of prudence provides more stability for employers and minimises the potential for funding gaps to be created. I'll say no, yeah, we've engaged Hymans already. They will, as a result of starting probably a couple of months earlier this time, be able to take into account the work that we're doing with Lgps Central regarding the climate risk report, which we expect to come through by November. If there are any significant findings, then we'd hope to build them into next year's strategic asset allocation strategy. Just to note that this year hasn't been normal by any stretch, and it's probably a good time to really kind of start early so that we can give it a bit more time than previous years. There is an appendix that kind of points out what Hymans are looking at. I'll just pull out the main points. They'll be looking towards property, they think, at the minute, given the changes that are occurring in the market in general, with people working remotely, that there's probably something in there that the fund needs to look at. Currency hedging. Our fund has a US dollar focus, given it's the primary foreign currency we have. We've also got Brexit looming on the horizon, so looking at our Keynes active currency mandate is on their horizon as well, and opportunities they pull out as well. If you remember back to 2008-9, where lending wasn't freely available, we've got a similar issue now, I suppose, where there might be opportunities in distressed lending, so they pull those 3 areas out to probably focus on further. I've got nothing more to say.
Any questions to Bullish on that? Could I ask again that you note the report, please?
Noted.
Noted.
Okay. We'll then go on to the Lgps Central Product development, and that's on pages 175 to 180. And again, that comes down to you, Bullish.
Okay, so this is a standard report that we've been bringing back for a number of quarters now. We'll go through each in turn so we can look at the products that Central are developing that we'd be interested in. Point number 5, we'll start there. That's the Global Active Emerging Market Bond Fund. We currently do have a holding in this asset class with Ashmore. It's worth circa 100 million and it's pretty much at benchmark allocation. This is one area which is now available. It just needs to pass through a couple of FCA hoops, and we've got an additional paper in the private section which we'll go through in a few moments. The next section, number 9, targeted return. This is at the earliest stage of development. Just going back to what Declan was saying, we have 3 managers currently within this asset class aspects, Ruffer and Pictet. We are interested in this product with one other partner fund in Lgps Central, and we are going to keep this as an asset class. We are interested in it. For the points made out in point 11. We see it as an attractive area. It gives us access to active management, and it takes us into areas that we can go short in as well via aspect. So we can benefit where markets are going down as well, and obviously that gives us improved diversification. So that's at its earliest stage. We don't envisage that to be ready before at least 2021. Point 12 is the multi-asset credit fund. Point 12 there kind of breaks out what kind of classes or investments are within those. So, it's high yield corporate bonds, emerging market debt as well, convertible bonds, credit, government bonds. We do have a holding with Central's investment grade fund, and we will have a product available that we'll make a decision on later for emerging market debt. So there is some overlap here, but the way that this fund has been constructed, it means that we won't have significant overlap. We do currently have a small holding, 0.5% in point 14 via JP Morgan Credits Fund, and we expect to build this up to a 4% weighting when this product is available. We expect it to be early 2021. 17 is direct property. We have a number of investments within the fund already. We're about 8.4% of the fund within property in total, and that's direct and indirect. Split across Colliers, LaSalle, and Keynes. Colliers manage a portion of our direct. We will not be transferring that to the new Lgps Central Fund, as pointed out in number 18. They're due to taxation and transition costs. So that'll stay with Colliers as it is. New money will be invested with Central's direct property fund when it becomes available pending committee approval. We expect that fund to be available early 2021, also at the current rate of progress. And I think that's probably enough at that stage. They will launch at a future time some additional streams. So we'll have, as pointed out in number 21, other arms where we can get into international property if needed, and indirect holdings as well, similar to our LaSalle holding. But that's way further down the line. 21 is infrastructure. This is slightly ahead of the property fund in terms of development. The fund has a number of investments already within this class with KKR, Infracapital, Stefan, who hold the Timberland area, and JP Morgan, who will be coming on later today in the private section to give an update. We have an allocation target of 9.75. We're slightly under at the minute. We're not too concerned by the slight under at that point. We will bring something back as we get closer to the launch of that product. So they're the ones that Central have got in the pipeline that we're interested in. The other matters, points 26 and 27, the Director of Responsible Investing has resigned at Lgps Central. We've probably spoken to him in the past. Michael Marshall will be coming on at the end of this committee to give some training. The role has been advertised already. Number 27, that long-standing
Okay, again, any questions to Bulesh? No. Okay, you're asked again to note the report.
Noted, Chair.
Okay, we're now moving on to agenda item 16, the recommended investment into Lgps Central Global Active Emerging Market Debt. And I think, Bulesh, you're going to be joined by...
We'll run through this paper to begin with, and then we'll come back to private session to be joined by Central.
Okay. Right, Bulesh is going to set out the main information on the recommended investment, and then ask any questions. But then we will be moving into an exempt part.
Sure. Yeah, we'll have Gordon from.
Okay, and then we'll be then welcoming Gordon Ross through that part of it. So could I ask for the first part of 16 for Bulesh to make that presentation?
Thank you, Chair. So the purpose of this paper is to give some background into Central's Global Active Emerging Market Debt Fund. The background here is that we do have an existing holding with Ashmore. We're close to target 2.5%. The three partner funds have expressed an interest in this fund by collective discussions with Central. The fund is pretty much available pending some FCA approval. We brought this to committee last quarter. The managers have been selected, so points 8 through to 10 run through the two managers that have been selected. So this mandate will be run by two managers. M&G, a larger, well, I say it's large, it's smaller than Amundi, but M&G, 340 billion assets under management with fixed income assets of about 170. And Amundi, the second manager, is a larger European asset manager with 1.5 trillion assets under management. 37 offices, cover the world really. And those are the two that we'll be looking to use going forward. The costs of this mandate are far lower than our current mandate costs with Ashmore. We envisage that if we transfer 100 million, for example, the savings of our fund on management fees alone would be £500,000 a year, so 50 basis points. There are transition costs to be taken into account, 30 to 35 basis points on moving things across, under normal market conditions. Declan mentioned earlier that if we were to transition at a time where volatility was higher, then obviously those costs would ramp up as the bid offer spreads on securities widen. The targets that have been set for this mandate is to outperform the benchmark by 1% over rolling 3-year periods. That's at 0.14 on the paper. And it's worth noting that the benchmark doesn't contain any local currency bonds or corporate bonds, but the guidelines do allow the managers to hold up to 30 in local currency bonds and up to 30 in hard currency bonds. Hyman's did complete some due diligence for us on this. Nothing negative came out of it in the sense. I've got some highlights there in points 16. And the Hyman's do like the idea of having a manager that can spread across the whole range of emerging market debts. So that's hard currency, local currency, corporates, and both of these managers allow us to do that. They also point out that the fee schedule looks very attractive compared to our existing, which we noted earlier. I think at that point it's probably worth taking a break. Then we'll take the questions within the private session, along with Gordon Ross fielding questions that the committee may have.
Okay. Could I ask you just to keep your questions until we go into the private part of the meeting when we're joined by Gordon Ross.
Chair, could I just come in just for clarification?
Yep.
Yeah. But what's the AUM? Can you just clarify?
Assets under management.
Assets under management, yes. So,
Right.
so currently we have about 110 million pounds assets under management in emerging market debt.
Okay, thank you. Thanks for that, Chair.
All right. So just leaving that for the moment, can I move on to the future meetings of the local pension committee? And you've got them listed down there. So if you could note those, please, and that the Leicestershire Pension Fund annual, the AGM, will be on the 14th of December. Okay.
Okay, noted, Chair.
Noted. Yeah.
Okay. There are no other items which are taken as urgent, and now we're on to the exclusion of the press and public. And I move that in accordance with the Local Government Act 1972, the public be excluded from the meeting for the remaining items of business on the grounds that they involve the likely disclosure of exempt information. So could I thank those who have been watching on YouTube, but it will now be no longer live. So we'll just wait for that discontinuation.